Harvey and Alex, this is the 40-year-old example you had asked us to put together for you a bit ago. Just not having a chance to do this, that's how busy we've been. But this is a $20 million design for a 40-year-old. The state doesn't really matter. This is a Rhode Island case, but it could be Florida, California, everywhere in between. It doesn't matter, really. We can also do this for wealthy global citizens, individuals that have citizenship in other countries, but they have access or U.S. investments and they want a U.S. domiciled policy. So here's a 40-year-old, $20 million. If we did a term policy, which is, I'm sure you guys have heard of term insurance before. We did a 10-year, 20-year, or 30-year term policy that was convertible to a permanent policy. The annual premiums would be $13,000 a year for 10 years, $22,000 a year for 20 years, or nearly $40,000 a year for 30 years. For a $20 million term policy. Less than 2% of all term insurance policies ever written have paid a death claim. So they're typically not seen as the most astute financial. If we're looking to cover a specific window of time, we have a strategy that allows for you to get basically term insurance or life insurance cheaper than term. Let us know about that. But if we're looking for a permanent design, then we need to look at permanent policies, and that would be indexed universal life, whole life, and variable life. And on a $20 million design, to maintain the death benefit according to how our premium finance structure looks, the required premium on an indexed UL policy is a $204,000, almost $205,000 a year for 10 years. So nearly $2 million out of pocket. Same thing with the variable life, about $200,000. A whole life policy that has all the guarantees and is one of the older types of policies in existence requires $800,000 a year of premium payments for 10 years, nearly $8 million. And you can see on the death benefit, based on the out-of-pocket payment, what the internal rate of return or what that asset class would yield if it were an investment in the portfolio for the individual. So right around 5%, not that attractive. However, when you properly apply leverage to an indexed universal life policy, and we get a bank to finance the premiums on behalf of the client, and the client simply pays 10% of that amount out of pocket, you can see how the internal rate of return jumps from 5% to 10% from a death benefit perspective. We also have the ability to create tax-free distributions for the same individual starting in 16 years that would yield approximately $636,000 a year of tax-free distributions. So let me go through this with you real quick, and this is what we can set up another call to talk about in detail as we start to dial this in for you guys and who you want us to present this to. Column 3, 4, 5, 6, and 7 are life insurance policy details. To properly fund the policy, the maximum premium that we're going to borrow to fund the policy is $1.1 million a year for 10 years. Go all the way over here to column 12, you can see $112,000 a year. That is simply 10% of the premium that we're borrowing as a suggestion to be paid out of pocket by the client or the insured. That is not a requirement. This is where policy design or structure of the design comes into play. But as a starting point, we always show about 10% of the premium being paid by the client out of pocket. So again, back to columns 3 through 7. These are life insurance carrier illustration details. So when $1.1 million goes in year 1, the policy value is projected to be $960,000 at the end of year 1. So the difference between the premium going in and the policy value is policy charges, fees, and expenses already baked into the design. The cash surrender value in column 6 is the portion of the policy in that year that the bank is able to take as a lien for collateral purposes. And then the gross death benefit in column 7 is the initial $20 million plus the policy value being added to it for $20,959,000. Columns 8 through 13 are bank lending information. So as I mentioned, we're going to have a bank loan $1.1 million at an interest rate that the bank is going to charge, and the interest on that amount of money that the bank is loaning minus the projected out-of-pocket payment of 10% that we show here, which means an ending of the year loan balance of $1,079,000. This loan balance can be set up as no personal guarantee, non-recourse lending for our clients with our special banking relationship. So if this $1,179,000 is the outstanding loan balance, and the portion of the policy in year one that the bank can take as collateral is $281,000, that leaves a $797,000 shortfall of collateral for the lender that needs to be pledged by the client as cash, cash equivalents, marketable securities, and things like that. And then the net death benefit is going to be the gross death benefit in column 7 minus the outstanding loan balance in column 13 equals the tax-free death benefit that would go to beneficiaries. And then any collateral pledged, if the death would have occurred, would be released back to the client or the client's estate. So we do this every year, wash, rinse, repeat. And based on the assumptions of an illustrated growth rate of 6.2%, based on $112,000 a year of out-of-pocket payments in this example, again, that's customizable. In year 3 of about $830,000. And by year 7, that collateral is gone. And we show the client continuing to make payments of 10% so long as the premium is being paid. Again, that is customizable. We show the bank loan being exited in this example in year 15. And for this 40-year-old, in the 16th year, this individual is projected to be able to take $636,000 a year income tax-free as a supplement to retirement, as a supplement to selling business, as a supplement to royalties for the rest of their life, $636,000 a year for the rest of their life. So they paid, as an example, or $1.1 million of true cash flow was paid in. And by the second year of $636,000 distributions, they've got a reimbursement or they've recouped their out-of-pocket, and every dollar thereafter is tax-free distributions. All because they paid $112,000 and they had the ability to pledge $830,000 of collateral in this example. And you can see at age 75, after taking nearly 20 years of $636,000, so nearly $12 million of distributions, it still has an $11 million death benefit tax-free for beneficiaries on top of the distributions. If we set this up where distributions was not the primary focus, but instead it was death benefit proceeds or liquidity for beneficiaries, at age 75, you can see the death benefit over here is $46 million tax-free. But again, not taking any distributions of $630,000 a year. If we did take the $630,000 a year distribution, again, for 20 years, that's roughly $12 million of distributions, income tax-free, as well as an $11 million residual death benefit for beneficiaries. And so this is what we can do. This is how we can design things for prospective clients, for referrals, and as a retention tool for your artists and for your talent. We can do this on a lower scale. We can do it at 10 million. We can do it at 5 million. Again, it's all customizable in how we set this up. It's all based on what we're trying to accomplish.